Thank you for the introduction. And what I want to do in my 30-minute presentation, I want to look back a little, what has happened over the last year, because it will give us a better understanding of what we're about to see as well. And then, of course, I want to look ahead of what we can expect for the rest of 2021. Here's sort of a scary picture at the moment, and let me tell you that this presentation is not going to be scary at all. I'm just making a possible backdoor for me to say, well, I said there was a possibility of something bad to happen. Our outlook for this year is very positive. We expect, I'll pull this up right now, we expect GDP growth, output growth of 7.4%, and that is for the year. And so that will be much higher, not much higher, somewhat higher than what the Fed has forecasted and what the OECD has forecasted for the US. In the current quarter, we see growth of 6.8%. So all of that, of course, requires that we don't have a setback of a third wave. And I don't believe that there will be a third wave, if nothing else, because if you look at Southern California, as of a week ago, 21% of 16 to 40 to 64-year-olds had at least one shot already. And if you add to that 20% who probably were infected, and that's a low guess, could be much higher, then we are starting to approach herd immunity, which you will reach at 70%, right? So here's the scary part. If you look at Europe, Europe had gone just like the US and California. They had gone through a second wave. It started a bit earlier. And then sort of after that, they came down just like we did, and then sort of plateaued, and then all of a sudden they started to increase again. So is this increase serious? Well, Italy, as of last Monday, has gone into a complete lockdown. As of today, and we're talking Wednesday the 19th, Paris is going to go into lockdown, and 15 of their areas are also going to lockdown. Germany is considering to go into lockdown for several of the counties, right? So I've put in California in here together with Italy. So you can see in Italy how the third wave started, and California is coming down from the second wave. And so the question is, are we going to continue on this downward trajectory? Certainly something that we see in San Bernardino County and in Riverside County. We are now below the rate of 7 infections a day. But will we stay there? And so I believe we will. But just in case it doesn't happen, in case there is a third wave, these were my two slides for that. So where are we? So a year ago, we had a debate of what the shape of this recession was going to be. And at the time, to tell you the truth, I did not know what was happening. I had a canary in the coal mine. My canary in the coal mine was Coachella. And if Coachella was going to get postponed to October, in which case it was going to be called Spookchella, then I thought we would have a mild recession and we would be coming out of it. If Coachella didn't take place in October, and it didn't, then I thought the recession would be much more severe. Then again, you would go into 2021 and you would say, will there be Coachella in April? And again, Coachella was postponed until October, and now it has been canceled, right? I suppose it is easier to hire Pluto and Mickey than to get Blackpink to sign a contract for October at this point. So as a result of that, we thought the recession would be more severe, and it was. You can see the big decline, and you can see that we came back up, making it look like a V-shaped recession, but then it flattened out in the last quarter. Now, we believe that with growth as we had anticipated, or as we have forecasted, of 6.8%, we're almost getting back to where we were before the recession started. That will happen in the second quarter. And then you see the line above, which is sort of a trend line, which says, what if the economy had continued to grow at a pace of 2.5%? Well, if that's the case, it will take us a little bit longer. It will take us until the beginning of 2022. But we will be back. Now, if you want to call that a V, I wouldn't, but it certainly is a return to where we were, and definitely faster than, frankly, I anticipated last year. So that's output. This is employment, and this does not look at good. So employment, you can also see we had this huge decline in employment in the United States. And then we come back, but different from GDP, that is really flattening out. And so that is worrisome. That means probably that it will take much longer for employment to come back. Now, remember, when we were in the Great Recession of 2008, 2009, it took us until 2014 to get back to levels of employment in 2007. That was unheard of. In other words, all the other recessions that we had, it never took that long to get out of it. But it happened then. And this is the worrisome part, that it will take, again, 7 years to get out if this curve flattens out like it does. Here's something interesting. If you have time, go to a website called tracktherecovery.org. It's run by Harvard University and by Brown University. And they have an immense amount of local statistics based on the idea that you don't want to wait until federal statistics are being published, but they take credit card data, they take small business revenue and sort of analyze it, right? And display it much faster. So here what they have displayed is what has happened to employment in the United States for 3 different types of wage earners. And this is well known. This is very much relevant, for example, for the state of California in terms of tax revenue and so forth. So the highest income earners are already back to where they were prior to the recession, right? And the middle ones are sort of returning. They're not that far away. It is the low wage earners that are really suffering. So this sort of creates a scissor. And it's a scissor between high wage earners and low wage earners. The people who think that this recession is K-shaped, that's the idea here, right? So in the K-shape, you have the top income earners coming back as they did, and you have the low income earners who are dragging behind. Okay, so where were we before the pandemic? We were celebrating. The National Bureau of Economic Research puts up all U.S. recessions since the 1800s. And we never had an expansion of 128 months, right? So we set a new record of an expansion. Actually, we were thinking, does an expansion die of old age? Well, Australia, by the way, hadn't had a recession since 1990, so why not go on? And so everything looks fine in February, and we think we will get more of an expansion. And then, of course, the coronavirus happens. And you can see here with unemployment and consumer sentiment, unemployment had reached levels that we hadn't seen before. Look at this. We were at 3.6, 3.5%. You have to go back all the way back here to see unemployment rates that low. Consumer sentiment, doing very well, sitting up there, right? There is sort of a little spike in the 90s or in the early 2000s. But if you wanted to get to levels of consumer confidence like we saw in February, you have to go way back. So everyone was feeling optimistic, and there was no reason really why the expansion couldn't go on. And of course, then we see this increase in the unemployment rate, not in March. In March, there was a mild increase for a technical issue, namely, the survey that looks at the unemployment rate is taken on the 12th of each month. If you remember when the shutdown happened, it really didn't happen until the 19th, right? So the unemployment rate initially just went up by 1 percentage point, but then it spikes to levels that we have never seen before, right? And consumer confidence, of course, goes into the abyss, right? Hits rock bottom. What do we have here? GDP, the same thing. We're doing well. This is sort of 2.5%. In the Trump years, we were growing at 2.5%, not as high as he wanted. He had talked about 4%. We ended up being at 2.5, but we were doing okay. And then, of course, we collapse. And I will get a little bit more into that, right? Housing starts. That was the big difference from expansions before. Housing starts, if you look at averages, long-time averages, right, you get to 1.4 million in the United States per month. That's annualized, right? And you can see that average. You can see it over the years. And then, of course, because we had a housing bubble, new housing starts completely collapse. I mean, they cannot collapse below zero, otherwise they would have. So we were down, and just as we were getting back to this average of 1.5 million a month, just as we were getting back to that average for the first time, then, of course, the coronavirus hits, right? So I'm painting this picture of life looked good in February. Then, of course, comes the pandemic. I remember coming from recording just like we do today, going back and going to Trader Joe's and to Vaughn's. And Trader Joe's, the aisles are empty. In Vaughn's, there was no toilet paper, right? In Vaughn's, for another reason, all garlic is gone. But meat was gone and so forth. I mean, people were just in a panic. And so this is what happens in the first quarter. GDP goes down by 4.7%, 4.8%. Now, you have to realize, it actually went down by 5% because it's a sum of these. Now, you have to realize if an economy for 10 weeks in the first quarter grows at a rate of 2.5%, for it to collapse down 5% in the last 2 weeks, if you do the mathematics, you will see that it had to collapse in the last 2 weeks by, get this, 32%. That's the equivalent of generating this. And the graph is interesting because it actually shows you that, of course, we continue to buy non-durables. That's what we needed, right? But the collapse was really in services. So we didn't go anymore to the hairdresser because we couldn't. Manicure, pedicure, or if you wish, tattoo parlors. Investment also went down. The foreign sector actually helped us. But overall, GDP goes down by 5%. Remember, that's basically in the last 2 weeks of March, right? And then, of course, comes the next quarter, and that's the abyss, right? We are going down, if you add these things together, by a rate of over 30%. I mean, this is unheard of. We're just sitting there. This is like you're in a free fall, and you don't know what's happening. This is interesting, particularly with the Inland Empire in mind. Here's where we start in 2007, and this is employment in the Inland Empire, in California, and in the United States. And we all know this, since we were one of the epicenters of the housing crisis. Employment in the Inland Empire really went down, right? And it took a while for it to pick up. California and the United States were already on their way up before we started to finally see improvements in employment. But then, this is the important part, but then we crossed paths in 2014. So that meant, starting here, that the Inland Empire employment actually had to grow faster. And that's what it did. And we ended up there. Now, I've done different calculations, and they will show that income in the Inland Empire did not grow by that much, suggesting that the growth we had in employment was not necessarily the best or highest paying jobs, right? And then, of course, you fall. You go through the basement. Notice what it means going through the basement. All the employment gains in the United States from 2007 until here gone. They're gone. You've got a lost decade, right? California, the same. The only reason why in the Inland Empire we didn't go back to levels that we had seen here in 2007 was because we had generated that additional amount of employment growth, right? So that was the situation in terms of employment. California. Here's what you need to understand. If you want to talk to people about this recession, here's what you need to understand. You need to understand to just focus on one sector. Focus on leisure and hospitality, right? Here what I've done is I've shown the increase or the decrease in employment in different metropolitan statistical areas in California. And I have also shown in those metropolitan statistical areas, I've shown the share that leisure and hospitality has, right? So, for example, in Los Angeles, the share of leisure and hospitality was 11.7%. Hence, the employment loss was very high. Monterey, even higher, right? So the first lesson, if you wanted to explain where the big employment losses came from, starting in March and going through April, maybe May, all that you have to think about is in the area that you were, how much was the share of leisure and hospitality? The bigger the share, the bigger the loss, right? Here's where we are in June, sort of just turning things around a little, in June of last year. So in California, we had the second highest unemployment rate out of all US states, right? There was only one more, Hawaii. Why Hawaii? Leisure and hospitality, right? What is at the other end? South Dakota. So what does South Dakota do differently from what we did in California? So I tell you what, I've investigated this. Number one, they didn't shut down the economy. They basically left it open as it is. And therefore, by the way, they had a much higher mortality rate than we have in California, right? But the business didn't suffer. Two, leisure and hospitality in South Dakota is not as big a share of the economy as it is with us. What is their big share? It's manufacturing. And in manufacturing, it was much easier to spread out people. And three, it's population density. Who lives in South Dakota, right? There aren't that many people there, and they're all spread out. So it is much harder for the virus to spread, right? But you notice that when we are at double digit or close to it, unemployment rates, they are at 3%. That is just stunning, right? So it's not like this coronavirus recession affected every state in the same way. There were clearly some states that were affected more than others. The same thing with the metropolitan statistical areas. Not all of them were hit as bad as, let's say, LA County, where the unemployment rate in LA County was over 20%, right? If you want to explain someone what happened during the recession, go with this graph. Here's California, here's the United States. There were 5 sectors that were primarily affected. Think of the dark red line. That's by how much employment went down when it hit bottom. What were the 5 sectors? You can name them because it's easy to guess. Leisure and hospitality, right? We know this. Next, to the right of it, other services. It doesn't look as severe because there are not that many people working in other services. But that is hairdressers, that is pedicure, manicure, this is tattoo parlors, this is gyms, right? What are the other spikes here? Well, there is retail trade, obviously. Then there's the one that is not obvious to you, probably. Maybe you wouldn't have guessed, and it's education and health. And here was the thing. Why would the health sector suffer when we have a coronavirus recession? And the answer is it suffers because you and I didn't go to the dentist anymore. If we had any chance to not go to the hospital for some routine minor injury that we had, we did it. We stayed away, right? So there were hospital wards that were empty. and that is reflected in employment. And it's not only in the United States, same thing happened in the UK. And finally, the other spike that sits there is professional and business services. Now, look instead of at the dark red lines, look at the light red lines. Or you know, I'm sorry if I don't get the colors right. I'm a male. I only know 4 colors. Maybe it's called pink. So where we sit at the moment is the pink, and you can see basically all the sectors have recovered, with the exception of one: leisure and hospitality. And even now, we are still only sitting at something of the order of 30% less employment that we had in February. This is hopefully changing, right? We all of a sudden, now that we've moved in the red tier, all of a sudden we can do some indoor dining. There will be some capacity that you cannot go above 25%. There will be people in Dodger Stadium, right? Not that many, but more so than if we were in the purple tier, in which case only friends and family, 100 people can come, right? But even at 20%, it's not as bad. At least you don't have all these carton people that you had before. At least the fan noise is no longer canned fan noise. It's the real thing, a little bit at least. Now, I have to admit to you, I go to Banc of California to watch the LAFC, and the ruckus that the 3,200 or so hardcore fans make behind the goal, you won't see that for a while. You won't be able to stand that close together and dance together and so forth and so forth. But at least it's a start. Disneyland is going to partially open, right? Starting at the beginning of April and so forth. So all of that will result in leisure and hospitality coming back. Right now, this recession is over if we can get rid of the remaining employment losses in leisure and hospitality. If we did, the unemployment rate would go down to 4% in the United States. Again, track the recovery. Consumer spending, it hit the trough here. By now, we're just 5.2% below where we were when we entered in February, right? I highly recommend that website to you. Changes in small business revenue. If you go to the website, what makes it even more interesting, you can look at small business revenue, and this is based on credit card spending, by putting in the zip code that you are in. And what you will see is that rich areas were hit much harder than areas where income is less. For example, the city of Claremont, which is not in the Inland Empire, but it's the last community in LA County, lost 82% of revenue in April. That is unbelievable. If you look at Upland, it's 12%. Go into the Coachella Valley. If you look at Palm Springs, the loss is something of the order like 70%. In Indio, actually small businesses gained by something like 2%. Same thing for the city of Coachella, right? So this is not evenly distributed. It turns out that the richest areas, Malibu, suffered much more than areas where you just have low-income people and they still have to buy food, right? So this is quite interesting, and I really urge you to go to that website. Okay, we're recovering. This is the third quarter. We're bouncing back like at a fast rate. You add these together and you get growth of over 30%, right? And it's evenly spread. Services is really coming back, right? All goods, non-durable goods and and durable goods are in the positive. Investment is coming back. So this was in the third quarter in the fall, right? And it's looking good. And finally, in the fourth quarter, we sort of flatten out. But you had to expect that after that big bounce back, right? This is when things flatten out, as you saw, sort of. What I've done here is I've listed for each one of these sectors where we are currently in terms of percent of employment that we had in February. And again, you can look at this in more detail. The slideshow will be made available to you, and you can see that really we're talking about leisure and hospitality. That's the sector that you really have to worry about. With the others, in many ways, you're back to where you were before. Let's get a look out for the rest of the year, right? The idea is the pandemic will no longer last. This is depending on vaccine deliveries, right? There are some shortages there that we have experienced. At Dodger Stadium, people were sent away and so forth. But this will be all sort of straightened out, we assume. The economy will recover. Will it be V-shaped? I don't think so. But we will recover, and as I said, in terms of output, we will be there in the summer. In terms of output, if you add the normal growth that you would have expected from the pre-pandemic, it will take until the beginning of next year, but otherwise we will be there. Employment, it will take longer. Okay, what about the Biden policies? So there are many details in the Biden policies that I don't want to get into. I just want to focus on 4 of them. There is the $1,400 direct payment for individuals. There's the additional $300 of unemployment insurance that was originally $400 and then reduced to $300. There's the Paycheck Protection Program, for which we in the United States do not really have a history, but in Europe, this is quite well known. In Germany, for example, Kurzarbeit, short labor, meaning the state basically paid firms to keep workers on. And this has a long tradition there. And finally, the idea that state and local governments will get $400 billion, right? So what I've done is I've tried to figure out which one of these will have the biggest impact and which one of these will have a lower impact. And both of my children will hate me for saying this, but the $1,400 will have the least impact. And why is that? Well, first of all, it is an across-the-board payment, whether you need the money or not. And what we know with similar payments at the beginning of the pandemic, what those who were working did is they just paid off credit card. We know this from credit card data. Or they actually ordered durables, right? So they ordered things on Amazon that were durables rather than spending it on leisure and hospitality, which is the sector that needed it, right? So the $1,400 is nice for those who receive it, but let's face it, it's not the most effective way of spending it. Going from the bottom up, the next one is the payroll protection program. So we had that also earlier in the recession. One of the problems was that firms that needed it the most didn't get the payroll protection right away. It went most to firms that had the best connection to banks. And if you had a very good connection to the bank, you were more or less guaranteed that you got the money early. And the firms otherwise that needed it the most had to wait for quite a bit. The third highest, or the second one from the top, is this additional $300. It turns out, looking at people who were unemployed when they received a similar additional amount in the spring, that they actually increased their spending. They increased their spending. So we know this again from credit card data. And believe it or not, state and local aid is the most effective one. If we look back at the Great Recession of 2008 and 2009, it was those states that received, per capita-wise, the most funds from some equivalent program to that. They generated the most of additional employment. Now, we in California are really placed well because the state is actually running a surplus. Why is the state running a surplus in terms of tax receipts? Well, because you saw it, the high income earners are really back to where they were before. The stock market is doing well. So the state budget relies on high income earners in terms of its tax revenue. And so the state is having a lot of extra money. It's the municipalities and the counties that have suffered. And this is where we expect most of this aid to go. A, from the state surplus, and B, from the federal aid that is going to get given. Inland Empire. So, here are the latest numbers in terms of unemployment from our great state of California. If you're in the darker area, you have higher unemployment rates, such as in Los Angeles County. If you're lighter, you are better off. Whereas the Inland Empire, sort of sitting in between, some darker shade of blue. If we say that the Inland Empire is doing relatively well, that hides, of course, variation across cities. So in December, you have Adelanto and Coachella at unemployment rates of 16 and 18%. And at the other end, you have Rancho and you've got Chino Hills with unemployment rates that are quite low, right? So even though we're doing well in the Inland Empire, you must realize that there's a lot of variation in between, right? So I've tried to explain the variation in two ways. One, what I've done here is I've simply measured how far each one of these communities is from the nearest county line. So most often that county line is Los Angeles County and Orange County. If you go south on the 15, of course, then it's the nearest county line is San Diego County, right? And it does suggest that if you're closer to Los Angeles County and Orange County, that you are doing better in terms of unemployment rates than if you're further away. But that's a very loose fit. What is much more important is this fit. And it shows you that the higher your human capital index is, the lower your unemployment rate. So human capital index is basically here, number of years of education times 10. Right? And so that establishes the human capital index, and the more educated your labor force is, it's not surprising, the lower the unemployment rate. And that's actually quite a good fit. You want to know how the Inland Empire did compare to other areas? These are the unemployment rates in the United States, California, the Inland Empire, and Los Angeles. Los Angeles is the disaster. Los Angeles County hit over 20% unemployment, right? We were never there at the Inland Empire. The United States seems to be doing the best. The Inland Empire is sort of in between there, right? That's where we currently are. This is interesting. The change in unemployment can be decomposed into the percent of people in the labor force increase and the percent of people gaining employment. So let me make a very simple example. Let's say the labor force stays the same, but employment increases. Well, not surprisingly, the unemployment rate goes down, right? You would expect that. That's like duh. But let's for the moment think that there's no change in employment, but people get discouraged and they drop out of the labor force. That also lowers the unemployment rate. So really what you want is the labor force growing and employment even growing more. What do we see for the Inland Empire? Here's the big difference. Look, for California and for the United States and for Los Angeles, how much the labor force fell. These are discouraged workers. They're the ones who've given up looking. For the Inland Empire, that didn't happen, right? We did actually not lose that much employment. If we had as many discouraged workers as we had in the United States, the unemployment rate in the Inland Empire would be 2 percentage points lower. That's stunning, right? So in other words, the reason why our unemployment rate did not fall in the Inland Empire more is because people were not as discouraged as they were elsewhere. And what's the function of this? Well, we have one sector in the economy that is doing really well in the Inland Empire, and that's logistics, right? It's transportation and warehousing and wholesale trade. And that sector in the entire recession has done relatively well because we've ordered things online. They have been delivered in trucks and so forth, right? Go sometimes down to Long Beach on a weekend and look at the number of container ships that are sitting out there. I have a picture of that. It's stunning, right? They're all ready to wait to be unloaded. And what are they going to do? They're going to go into the port of Los Angeles and Long Beach. 40% of all U.S. imports, not California, comes through those two ports. And you have no space down there to store things. So they're all shipped into the Inland Empire, and from the Inland Empire they're shipped out, unless, the train goes right through the Inland Empire into the other parts of the United States. So that's important. We're actually doing better than we're thinking, or that is visible in the unemployment rates, because we didn't have as many discouraged workers, right? Here are the 10 biggest MSAs, metropolitan statistical areas, in California. And forget the two colors here. There are two different types of surveys. One is we ask households if they're working, and the other ones we look at establishments. Unless there are a lot of commuters, as there are in the Inland Empire, typically they show you the same thing. Where do we stand? Not looking that bad. We have lost less employment than San Jose. San Jose is also called Silicon Valley, right? So we have done well. What is the other area that has done well? Is there anything in California that resembles the Inland Empire in the South? Well, if there is one, it would be Stockton. Same thing. Less employment loss, right? And why is this? Because of logistics. Stockton is the same thing in terms of logistics as the Inland Empire is in Southern California. This is the picture that I've shown you before to remember for the Inland Empire. Big loss in leisure and hospitality. We have not recovered that much. We will. And once we do, we will be sitting pretty. How about real estate? What I plotted here is monthly sales of single-family homes for the year 2018, 2019, and then the bars are 2020, right? So this is when your real estate agent was not looking very happy in April, May, and June compared to the years before, right? But then, look what happened. All of a sudden, we're going above the levels that we had seen in the previous 2 years. This market is booming, right? What about if we compare the Inland Empire to the other in Southern California areas? Look at Riverside County and San Bernardino County. Look at sales increases and look at price increases from a year ago. We have had higher sales increases and higher price increases than the other areas, right? Mind you, we're somewhat at a lower level here. Of course, we're more affordable. We know that than the coastal areas. Why? Well, one of the big drivers surely is the 30-year mortgage rate, right? And that is starting to come up a little, but it is still at low levels, such low levels that if you can get a loan, this seems to be very attractive. Unsold inventory, I leave that up to you to muse about. It is definitely not as high as it was in January of 2020, right? So we're basically at half of the unsold inventory that we had before. Housing permits, well, that's a problem. Year to year, we're still down, right? It's a great opportunity at this point to buy a house. It's a great opportunity. The interest rates are low. The problem is, can you get the loan? And the problem is, if you lost the job or if you are not doing well in terms of your credit score, then you cannot get into it. But if you can afford it, in my view at least, this is the time to buy. What about commercial real estate? Well, in the Inland Empire, industrial vacancy rates are quite low, right? And that is sort of throughout. bit of summary of the housing market. I'm running out of time, so let me skip that. Again, you can see these. Here's our forecast. So in terms of GDP for the United States, strong growth in this quarter. Overall for the year, this averages to something like 7.4%. These are, for annual growth rates, unheard numbers, right? This assumes clearly that there is a lot of pent-up demand. Households are sitting there with savings like they've never had before, and they are ready to go to restaurants, and they are ready to go on vacation. They just want to wait for the right time. And we also forecast for 22 that these growth rates will stay fairly high. California will take a while to get back, but eventually it will grow at a faster rate. Unemployment rate by the end of the year will fall below 5%, right? We started at 3.5%, and it will go back to below 5% at the end of the year. At the end of 2022, basically at 4.1%. Similarly here, inflation, no sign of inflation. Bit more than 2%, but the Federal Reserve has changed its target. The target is no longer that they don't want it to hit 2%. They want it to be on average 2%, and that's fine. And that is it. So the bottom line, what do you want to take away from this? You want to take away from this that our outlook is as positive as it can be, not only for the United States and California, but particularly for the Inland Empire. Are there any possible roadblocks in here? Of course there are roadblocks. And the roadblocks are, if we get hit by a third wave, we must be willing to pull the emergency brake. And we must be willing to set specific targets, whatever that target is, more than 50 in new infections per 100,000, more than 100. I don't care. Maybe you want to go all the way up to 200. But if it reaches that level, we must pull the emergency brake, just like they're doing currently in Europe. And hopefully, this will never happen. And instead, we will have a booming economy, and I'll come back in a year's time, and we'll be all smiles. That's it for the presentation. Thank you for listening, and I will be ready for questions down the road.